Hello everyone, hope you are fine. Today we are going to discuss the question of financial accounting, related to allowance for doubtful debts. Let's start. The turnover in a company was $2 million and its accounts receivable were 5% of turnover. The company wishes to have an allowance for doubtful debts of 4% of receivables, which would make the allowance 1/3 higher than the current allowance. How will the profit for the period affected by the change in allowance? Option A. Profit will be reduced by $1,000. Option B. Profit will be increased by $1,000. Option C. Profit will be reduced by $1,333. Option D. Profit will be increased by $1,333. Let's start to solve the question. First of all, we will write down the data given in the question one by one. First one is, revenue of a company, also called turnover, is equals to $2 million. As given in question, the receivables or debtors is the 5% of turnover. So, calculate the 5% of $2 million in order to find out the receivables. So it is equals to $100,000. And company wants to create an allowance for doubtful debts, that is, 4% of receivables. So, now calculate the 4% of $100,000 to find out the new allowance. New allowance is equals to $4,000. As stated in question that the new allowance is 1/3 higher than current or old allowance. One thing note that the current or old allowance is always 100%. So, if new allowance is 1/3 higher than old allowance, then it means, in this scenario, the new allowance is 100% plus 33.33%. Now see the calculation of 33.33%. We just write the ratio of 1/3 into percentage, as 1/3 equals to 0.333. To convert it into percentage, just multiply it with 100. So new allowance is 33.33% higher, and the percentage of new allowance is 133.33%. And old allowance is 100%, and we have only the value of new allowance, that is $4,000. So now, we calculate the old one by just put simple mathematical formula. Old allowance equals to new allowance of $4,000 divided by 133.33 and multiply with 100. And we get the old one, that is $3,000. If you confuse in the above formula, then learn one thing that if the percentage of two ratios and value of one ratio is given, for example, A and B are two ratios, the percentage of A is equals to 150 and the percentage of B is equals to 100. Value of A is $300 and we have to calculate the value of B. So, the value of B is calculate by dividing the value of A, $300, by the percentage of A, 150. And then multiply it with the percentage of B, that is 100. In this way we get the value of required ratio B, $200. Hope so, you picked this concept. Now, we compare the new allowance with the old one. As new allowance is $4,000 and old is $3,000. It means that the new allowance increased by $1,000. As increase in allowance leads to an increase in expense of irrecoverable debt or bad debt. Here is the double entry of increase in allowance for the doubtful debts. Debit, irrecoverable expense, by $1,000. And credit, allowance for doubtful debts, by $1,000. As expense increased by $1,000, so the profit will be reduced by $1,000, and correct option is A. Hope so you understand that question. If any confusion related to this, then just leave a comment and practice it, because practice makes a man perfect. Thanks for watching.